started this with the election. I can say I'm delighted it's over. The market likes the outcome so far. Honeymoon phase, perhaps we will see. But quite a bit of jostling did take place in the marketplace. We'll get into that. But I do want to congratulate all of you for riding through the volatility. It is the price to pay to get the return of the market. We said before, the political outcome tends not to have a huge impact on markets regardless of administration. Markets rise based on earnings. If earnings go up, markets go up. If earnings go down, markets go down. And I'm all about sales. If you have rising sales, you tend to have rising earnings. If there's rising prices, if you have falling sales in your business, and many businesses have falling sales, earnings fall, stock falls. First page indicates the return, total return for the administration throughout the history going back 100 years. Starting with Hoover, down 73%. And then, of course, you have a Democrat and another Democrat, and down the list you go. So regardless of candidate, markets go up. I will tell you that the next page has some real fascinating data on it, and I just ran the math myself. Is this page right here? If you only invest in your preferred administration and exit the market when the other administration comes in, regardless, Democrat or Republicans, you massively would underperform the market. This is 75 years of data. The data on the left, 289,000, is $10,000 growing to 289 over 71 years. I did the math just now. That's about a 5%. If you only purchase Democrats, you got a better return. I think it worked out to about 6%. So Democrats do a little better than Republicans, surprising to many Democrats or Republicans, but it is a fact. And again, it could be by circumstance rather than by policy. But staying invested through both parties, that's where you get your U.S. return of about 11%. So do not trade around political change or continuation. Just don't do it. It tends not to be profitable. A lot of talk about government spending. Both parties are going to spend more money. Spending is on the uptick, but so is tax revenue. There is no problem with servicing the debt in the United States. They have no problem paying the debt. Go down the slide, we're on page 3, by the way, showing the U.S. national debt going back 100 years, and it tends to rise, year. The trend is what you see, quite clear. The economy grows, the debt grows, et cetera, et cetera, et cetera. So nothing is new about U.S. debt rising, nothing at all. No one likes it. I think there's too much debt in the system, period, but it is sustainable today. And again, to bet for it to end is an outlying bet. It's a bet I would not make, unless things got pretty extreme, which we're still not there. There's no default. The credit rating agencies still give them, the AA plus AAA rating, whatever the case may be. I would not bet against that. I would not bet against it. Slight hedge, perhaps. Many ways of hedging. We can talk about that. But the administration, regardless, Trump or Kamala, more spending without question. Interest rates were just lowered, quarter point in the United States, a half a point in Canada. I'll tell you what has happened. Yes, the short-term interest rates have gone down. That's the overnight lending rate. That's the rate that one bank can go to the central bank, or they will trade amongst themselves, either or. And they trade amongst themselves first. If they have to go to the quote-unquote window, which is the central bank, they're in trouble. So no bank ever wants to go to the central bank to borrow money. They'd rather borrow amongst themselves. They do it every single day to offset debits and credits. It's just high-end mathematics, closing out trades. So that interest rates dropped another 0.25%. It's still high, and it will probably drop again this year by another 0.25 point. Maybe done, maybe more. But what has happened is 5-year interest rates, 10-year interest rates, 2-year interest rates, and 30, not so much, but a little bit, have all risen. And that's why you see the mortgage in the United States, the 30-year mortgage actually moved up 0.5%. As rates are falling on the short end, long rates rose. So it does actually speak to economic strength, but it also speaks to, the price of money is going up for most borrowers, not down. Here at home, we'll see, of course, what happens to mortgages and how they reset. Interest rates in Canada are well over 1% lower than America. Our Canadian dollar is a lot weaker than the American dollar, as you know. So there's a reason why our rates are low, because we have a weaker economy. But there's no run on either, which is a good thing. If we have a weak economy and high interest rates, then we got real trouble. Going on to the next page, markets follow earnings. Always have, always will. Not in a perfectly straight line, not quarter to quarter, day to day, but over time, earnings rise, markets rise. And as you can see, this is just for the broad S&P 500. Earnings are expected to in a 2.25. I believe it's this quarter. I think they're targeted to go up to 240 or 250. Next quarter, about a 14% bump in earnings rising. So if earnings go up 14%, the market could, for all intents and purposes, rise the same amount. We will see. This has been, by the way, a bit of a weaker earnings quarter. Earnings came in rising by about 4% this quarter. So we got a stronger quarter in front of us. Housing. Sorry, Jeff,
yeah, just to add to that, everyone was talking first half of the year about the Magnificent Seven or Magnificent 10, whatever the number of stocks was, but now you're actually seeing broader earnings growth across the board. So the other 490 stocks you're seeing participating and starting to take the baton from those 10 names. That's been going on, I'm going to say, since the summer.
Housing in the United States, housing in Canada is a big problem. We own some housing stocks, and it's amazing, U.S. housing stocks. And it was actually incredible that they went down coming out of the U.S. election. For some reason, the Trump market just knocked the housing stock down. I don't understand why, other than interest rates, but that is kind of odd. The rates have been doing their thing for the last 9 months, not 48 hours. Nonetheless, affordability in the United States is dropping. That is a problem. Home prices in the United States are rising. And again, I would say, are you better off now than you were 4 years ago? Is a funny statement that the Republicans certainly led each rally with. But the irony is, if you have assets in the United States and you're at home, you're basically worth more money now than ever. Certainly in the United States, our housing market is what it is. But your accounts are basically flirting with all-time highs. So assets have peaked out or hitting new highs. Next page. Excuse me. Next page. This is just talking about the Magnificent Seven, just the power and size of these companies. And we just look at the pure facts of Amazon, Apple, Google, Meta. It's a remarkable amount of money being generated. The amount of R&D spend that these businesses are deploying in artificial intelligence, new ideas, technology, driverless, you name it. It's astounding. And the point Jack's been hammering home frequently in this office is so much so that a company like Microsoft can commission governments to restart the 3 Mile Island nuclear facility because they need more data for data centers and for AI computation. So individuals, the moats, the barriers to entry that these companies have is astounding, and they will go out of favor every now and then, but the secular winds continue to be at their back, I believe. Many of those names, by the way, are well off the 52-week highs. Again, that's all part of Jack's statement. The market has broadened out, and there's been some rotation, some money out of those big 10 stocks into other names, which is actually very, very healthy. But NVIDIA is right now flirting with a new high, which is interesting. That's the company that gets to report earnings in a couple of weeks. Anyway, Apple, it has so much cash, it continues to buy back its own shares. That's a good thing. If there's less shareholders, your share of the pie increases. So it's a good use of cash. Warren Buffett buys into that theory. It's better than paying out a dividend because you, the shareholder, don't have to pay tax on it. It's a good use of cash if they have no better way to invest the cash. So as you see, Apple stock, they have bought back, here's the share buyback, right? Shares outstanding. They went from 25 billion shares to 15 billion shares. Oh my goodness me. Wow. So think about that. The company used to have 25 billion shares outstanding. They now have 15 billion shares outstanding. That means that they reduced the amount of shareholders by 40%, which means your share of the pie is increased by 40%. So it's interesting what's going on. in bad times, companies, well, there's bad times. What companies previously did was they kept issuing more stock and diluting shareholders. Stock options, they would dilute shareholders. Selling stock to make an acquisition is dilutive. Buying back stock is accretive to us, the shareholders. Amazon, there's sales. Get ready, the holiday season is upon us. Those trucks will be driving around the street, dropping off those little boxes, and yeah, Christmas every day. But Amazon, just look at this revenue of this company here, $103 billion this year. Wow, $103 billion. And just look at the chart of sales. Up. Look, next year probably 110, year after 120, 130. It's unbelievable. Combined revenue of the four big tech companies is $1.6 trillion, larger than the GDP of all countries in the world, with the exception of 15. Four companies are bigger than there's 200 countries in the world. So four companies collectively are bigger than 185 countries in the world. I wouldn't bet against that. And Microsoft, by the way, is almost made a 52-week low this year. It's in the doghouse because of their spend around AI. But again, they are spending now to benefit later, and the market will it come through? Who knows? I think it will. Anyways, I wouldn't bet against the space. We own some Amazon. I bought a little more today. We have a position in Apple, which is not acting great, but I'm fine owning the company. We have some Google, and we have a little Microsoft. Underweight the names, but we are still there, and I'm comfortable being there. Just look at the chart, the sales for their revenue, which is sales, how much stuff they're selling. It's going the right way. It's what I can invest in this. Very, very investable. I'm gonna take down, sorry. Little chart here on gold. Again, you want to sort of sell front page by page 15. Gold is front page. It is making new highs. Printing of money, lack of trust around the election. Who knows what? Who cares why? The fact is the what gold is rising. Gold stocks still are not really acting that well. I look at Barrick Gold, which is one of the first actually one of the first stocks I ever bought. When I was in broadcast, I had a stockbroker, guy like me, managed money for me, and they said, buy some Barrick Gold. And this was in 1995, and I bought Barrick Gold at $30 Canadian. Fast forward, 30 years? Barrick Gold today is 27. It's 10% lower than it was 30 years ago. It's the world's second largest, the world's largest gold producer. At some point, the gold stocks will kick in. The truth behind when is when the American money arrives in Canada. What gets the Canadian market going is not you and I and our RSP contribution, the TFSA. No, it is the U.S. investor. When they decide to come to Canada, they come hard and fast and buy it up, whatever it may be. And all we really have to is commodities: gold, oil, copper, trees, paper, and that stuff's not exciting. The latter, the former, they sort of get their head around. So that's truly what we need to see: a good bull market in commodities in Canada, and the American investor getting up here. And even with gold doing this, I spoke to one of our institutional advisors today or yesterday, and he said, they're getting a little interest in capital markets, from American investors, but the operative word was a little interest. Yeah, gold's at an all-time high. We do have a bit of a Agnico Eagle. That's one of the darlings of the street right now. We have a small position in Agnico Eagle, which is a gold producer, Canadian, big big gold deposit in Quebec, plus other deposits around the world. And that's in our TSX quant strategy. So we do have it in that strategy. And that, by the way, our TSX quant strategy is a pure Canadian strategy. So if you ever want more Canadian exposure, that's the way to get it with us. This shows you a ratio of gold and copper. Copper cheap or gold expensive. If you were to do a ratio oil to gold, oil cheap, gold expensive. I think ideally you want to, if you're fortunate enough to buy stuff cheap, sell it when it's expensive, not the opposite. Gold obviously moving with crypto, highly correlated. We continue to look at the crypto market, trying to find a way to maybe participate in it a little bit, but it's a very volatile, not challenging. It's an interesting space. I continue to tread lightly, slowly, and monitor the situation, but not chasing. Because when that stuff turns cold, boy, it turns cold hard and fast. Next page, and we're on page 11. I repeat, page 11. Daily activity in the market is basically random. You're flipping coins as to how the market's going to perform. Even over weeks and months, And styles. We have a style for running money. Our style works amazingly well over time. Any of our clients been with us 5, 10, 15, 20 years know what we're talking about. New clients, it's always such a challenge because they can catch us on a good month or on a bad month. And it can often set the stage for the rest of the relationship. Catch us when the market's weak, we just get a nice turn, and their accounts run real hard and fast. They think we're geniuses. Catch us after the market's moved up, nice and strong, then they call us, give us some new money, and the market reverses, and they think we're idiots. We are neither genius nor fools. We know what we're doing. The track record. This team, Jack, myself, Zach, and Kathleen, and our strategist and analyst manager, it is the best team in Canada, I believe. I truly believe that. I've seen the numbers. I've spoken to many managers across the street. It is a very, very great practice that we run, and I can't thank you enough for being partners in that success. But random in the short term. Long term, earnings rise, stocks rise. Own quality stuff. The businesses we own have rising earnings because they have rising sales. They're all high quality businesses that make money. They have good balance sheets, vetted. Yeah. Next page. Stocks versus bonds versus cash. On the left, S&P 500, it shows you the red bar is volatility. It is movement from the normal price, which is the mean. You buy stocks, you get a 10% return, but you have to take on swings in the account. So a 19% volatility, I don't want to get too technical with you here, but it's a basic statistics. That's one standard deviation move from the mean. That means in any given year, your account can be up 30%. You take that number plus that number, that's your average. So your account can be up 30%, or it can be down, take that number, minus that, down 10. That can be plus 10. That's one standard deviation. Two standard deviations, which is more normal. You double this number to 40, and now you say there's a 98% probability in any given year that either your account's up 50%, or it can actually be down 40 minus 10 would be 30, actually be down 30. So 98% of occurrences, your account will fall between a range of 98% of the time, your account will fall between a range of down 30 and up 50, two standard deviations. So that's the math. And I will say our portfolio's worst yearly return that we've generated on the board, annual completed yearly return, single digit. Our best positive return, 30%. So we're not hitting the extremes of two standard deviations, which is good. We're trying to keep the ball on the fairway, which in itself is a challenge. But we managed to do it time and time again. Cash, virtually no volatility, 3%, which is still something, and you get a 3% return. The point is, in the long run, the risk is not taking risk. The risk is sitting on the sideline, sitting out, and yeah, I'm still making 3%, but you're not making 3% because inflation is taking it all away. And if it's taxable, you're losing money. This is a guaranteed way to lose money. Sitting in cash on the sideline is a guaranteed way to lose money. But not money as in terms of pay. You still get your paper in the bank, but guess what? The purchasing power of it is significantly less. We just went through Halloween. There's shrinkflation and there's inflation. And Halloween is an example of both. Candy gets smaller. Can't get any smaller now, by the way. This year they didn't downsize anymore. They can't. There was 1 gram of candy, 3 grams of packaging. Anyway, the price of course gone up. Here's the next chart is inflation right there. So purchasing power down 50%. The Canadian dollar, US dollar, call it what you want, has lost purchasing power of 50% since 1995. So 5 is 30 years. 30 years, your money is worth half. Scary. And don't kid yourself. I've heard of people, someone passes away in a house, then the spouse has to clean out the closet, and all of a sudden, inside the old coat pocket is 20,000 Canadian dollars. Fact. Well, that 20,000 Canadian back in 95 had 20,000. In fact, today it's worth 10,000. That's exactly what happened. The 20 is worth 10. Don't fall back. Go ahead, Jack.
Yeah, there's that example, but there's also examples where clients, again, the election, in front of the election, I want to get out of a big event, or in COVID, I'm going to get out. And when clients get out, we've seen it time and time again, they don't get back in. So they may be right for a period of time that's relatively short. The market makes a new high or starts moving in the right direction, and they don't start to participate. So very difficult to get out and get back in and time both. So our recommendation for the most part is don't try. We're going to be active for you. They are high touch portfolios, but getting out based on an event, market event, is typically not a good strategy because clients do not get back in.
And again, we talked about that the open. Look, I will add this because you bring it back up, Jack. I will add getting out is easy. No problem getting out. Perfect. It's on page and the world is scary. Sure, get out. Easy to do. And no problem. We can line up orders and get you out of the market same day. That's the beauty of what we have is liquidity. But it can also be an Achilles tendon, Achilles heel. Achilles heel. But getting out's easy. Getting back in is brutal. And guess what? If you're a pro, which we are, you will get back. And if you're smart, and I think which we are, because we did get out this year aggressively when the market began to roll in March. It was a head fake. It was a mistake. And I got back in. Thank goodness. That's what a pro does. They correct their errors immediately. Pros make mistakes too. I make mistakes too. Always have, always will. And I can make a lot of mistakes and make a lot of money. I can't tell you how many clients began with us with a couple $100,000 who now have several $1 million over, 15, 20 years of staying on course, which is so key. This is a chart. I'll let you study the math yourself. It's interesting. But once again, and I updated our piece on our website about the 1% and how to become the 1%. Who are the 1%? How much you need to be a member of the 1% of society. Go to the website, you'll see the article. If you want, we can email it to you as well. It's just back, but it's fun to look at. The point is, most people I know, and 99% of our clients, the money that you have, you worked for it. You saved, you committed over time. So if you want to become wealthy, the most important thing to do is put money aside and save it. The wealthy barber, save 10% of your money each year, each paycheck. So if you do that and you get normal market returns, you will become rich. If you wait to the end and then you have a bit of money saved, now you want to make a lot of money in the market, good luck. Or if you retire too early with not enough money, then you have to overly rely on the market to deliver results for you. And the market is random in the short term, and that's where you can get smacked in the head. So again, rule of thumb that I created, we're going to call this Wolfonomics, is retire with twice as much money as you need. I say that because markets, worst case scenario, will fall 50%. So if you retire with twice as much money as you need and the market falls, for a nanosecond in the cosmic calendar, because it will be a nanosecond, it won't stay down, they don't get business, markets make new highs. They always have in the past. I expect the same to occur in the future. But if you have twice as much as you need and the market falls 50%, now you have enough. So you don't need to do anything silly to get yourself off court, and then leave it alone. You're back to having twice as much as you need and then some. So again, retire with more, not just enough, and you are safe. That's again a way to hedge risk. So you want to hedge risk, hedge crises, oversave. And Jack, what was your line on the radio? Four words.
Save like a pessimist, invest like an optimist.
Save like a pessimist, invest like an optimist. And I'm talking about, when we talk about optimism, I'm an optimist. I think Colgate will sell more toothpaste. I think Molson's will sell more beer. I don't own either stock, by the way. I think the banks will charge more fees. I think the banks will make more money. I think Apple will sell more stuff. I think Google will create more search and sell more advertising. And those are the businesses that I buy. And if that optimism holds, earnings will rise and the stock will rise. But this shows you the rate of return that you're looking for. And this shows you how much money, based on earning $68,000, what percentage of your income you save. So for example, if you save 10% of 68,000, that's this blue number here, and you generate a 1% return at the end of 10 years, you will have $236,000. So you saved $6,800 a year. You invested at 1%. At the end of 10 years, you have $236,000. If you only save 1% of your money, i.e. $680, and you generate a 10% return, at the end of 10 years, you have $111,000. The name of the game, save at least 10%, try to generate a 10% return and get a milspeed. And this is sort of what we're doing for our clients. We're sort of hit this number, this 10 long term, which is nirvana. So oversave, buy quality, stay for the long course, and you should generate returns down in here. Okay, next page. Yeah, so this again, I've showed this chart over and over again. Again, short-term markets random. Any year, these are the drawdown. So this is how much the market falls from its peak in the year, start of the year. So it could be any point in time, basically how much of a give back the market can take in any given year. On average, the market, just take a look at them. On average, the market falls 10% every single year at some point. I repeat, on average, the market tends to pull back 10% at some point in every year. Sorry, guys.
And the reason that it does that is always different, and it's not priced into the market. So it's something that the market was not expecting, and that's why the market is down.
No, it could. I'm going to say, if you have a big crash, unexpected, market ebbs and flows in the short term. So 10% movement up and down is not a big movement, and that can be just from drift, from a few or small things. The big surprise is when the COVID big surprise market takes it on the chin, whammo, or financial crisis that was brewing and became whoa. That the market didn't really price in, but short-term noise. Why is the market up today? Why is the market down today? Who knows? And even a 3, 4, 5% move up as we just had can easily be retraced with a 3 or 5% movement down. It's just mean reversion, I believe. Just noise in the short term. All right, so the next page. This is your portfolio, depending on which mandate you are in. But I write about these stocks. Here are the companies we own. All of the companies we own. This is ranked. This is our holy grail right here. This is our what we really pay a lot of attention to is this fact. It's 3 pieces of software grabbing data and looking at different factoids all put into one. So I'm just ranking all of our holdings on a technical basis. And if you look on the right-hand side, this shows you some of the factoids of the company. We'll start with a Canadian electronic manufacturing company called Celestica. We bought the stock in our TSX quant portfolio just recently. We're up 19% on the trade. It is our strongest stock. So when I say technical in terms of price action, on a 6% scale, which means basically over a 6-month period, it ranks number 1. Over a 4-month period, number 1. Over a 2-month period, number 1. On a price basis, it ranks 38 out of about 75 companies. So not great, but not bad. But what I like about this company most is this right here. Revenue estimates for 2 years forward. So not next year, but 2 years out. How much will Celestica's sales rise? And the answer is at 55%, which basically means Celestica is expected to increase its sales by 27% a year. So if you're working and you go speak to your sales manager and you ask your sales manager or sales rep, can they increase sales this year by 27%? MDA Space is another company. Sales going up 100% in the next 2 years. We just bought the stock. It's up 53%. Like, whoa, we nailed it. Luck, pure luck. You go down the list, you look at our stock that we own, most have rising sales. Here's a company, KKR, that doesn't. This company is a private equity firm. I just bought more of it today. The math is different with private equity just because they end up taking a big private position in an asset, be it a dam, a piece of real estate. It could be bridges, toll booths, air, who knows what. They hold it on their balance sheet. At some point, they sell it. That becomes part of it. They get their fee, and then it shows up as sales and revenue. So the math isn't that plain on this business. But the stock's going higher. It's our 4th ranked technical stock, and it's working. Morgan Stanley expected to grow sales by 30. So this is where I like to look at is sales rising. And as you can see, most of our companies have very good sales growth. You name it, Amazon, 36% sales. Like, are you kidding me? I showed you that it's doing $100 billion in revenue right now. So that means in 2 years, that thing will be doing $130 billion. Boy, it is Friday. Please excuse me. I do manage money, by the way. I'm not bad with that. Netflixer. Love Netflix. Love Netflix. We got this $10 a month. It's a bootleg digital box from Brampton, and we pay in cash on a monthly basis. Weirdest thing. Anyway, a gazillion channels, but it freezes out every now and then, and I get frustrated because I have 3 remotes to get the thing to work. I will just default back to Netflix. I know that's going to work for me. Love Netflix. Anyway, I tried it. So here's the stocks we own. The ticker, the name of the company, the technical rank, The weight in our portfolios, so how much of it we own. Now, this is a blend of all 5 portfolios put together, so don't look at the weight too much. I just want to show you the name of the business you own. Because the market, the media, it doesn't, you're not investing in the market. You don't just own the market. You own particular businesses that trade in the market. Forget about the media. The journalist that's talking to you, not me, but the journalist is a journalist. They know blank. I repeat, journalists know blank. The journalists, they're pretty, they're handsome, they're articulate, they look good, they can talk well. They're not business people. So focus on what you own. You know, Costco. Here's a company we own. It's number 54 on the list. We all know it. And I'll tell you what I like about Costco. Number one, they got a membership fee. That is pure cash. And number two, the customers that shop there are above average income earners and don't spend $50 as they do at Dollarama. They spend $500, $2,000 as they go to Costco to get what is it, a carton of cream. They come out with a couple bunnies of stuff. So quality business. So you know, if you're worried about the market, drive over to Costco, buy something. Tell me what you think. You know, we own a waste collection business. You know, Apple. It's a good quality portfolio. That's the most important thing. I do want to again remind you that our financial planning team are doing some great plans for clients. Always great to get a financial review. Update your plan if any major life changes. I want to really emphasize another point. It's happened a few times where clients have sought outside help to add life insurance of some sort into their portfolio, corporately held, personally held life insurance, and have gone directly to a life insurance provider. I caution against that in that life insurance providers focus on one thing, well, life insurance. Working with us, and we're all licensed in here to manage that part of your needs. We can proper holistic approach to insurance. You know, we don't rely on insurance to generate income. They do. They are unfortunately biased towards selling you as much as you can get often, and not truly understanding your needs in terms of being able to afford it. And does it truly fit? And will it generate the return to justify it? So I encourage you, please, if you think of any outside product, and there's other product out there that every now and then at a party or through rubbing shoulders with a friend, I get a call, you know, send a couple $100,000. I want to buy a private debt fund or this new fund that my friend is managing. Friend, I beg you to be careful with stuff like that. I beg you to speak to Jack and I about that. We've seen this movie before, and unfortunately, sometimes it doesn't end well. I don't want to say always, because it's not the case, but overall, when I look at the long-term result, no, we have done better than these private products. We tend to generate a better return than, you know, seg funds. There's another product that continues to get a bit of attention for the weirdest reasons, i.e. saving probate. So please, Jack and I and Zach and our financial planning team, we are here for you from a holistic point of view. You know, we care about your family and how much tax you have to pay or could be subjected to, market risk, hedging up portfolio. You know, in terms of risks out there, another point I want to make. You know, Jack and I are paying attention to a lot of different things all day long. We are aware of political events. We are aware of what's going on, you know, within multiple markets. So if you're hearing the news, likelihood we heard the news as well. And most importantly, the market has already heard the news and therefore priced it in. So, you know, we've had once planned. Are you aware Brexit's going down? Well, yeah, we are aware Brexit's taking place. You know, not Google us. Don't trade around something like that. So all I'm saying is, you know, big picture stuff, we're here for you. Minutia, we're here for you. If you're feeling queasy, we're here for you. I can't stress that point enough. You'll get the best advice when you work with our team. I'll say another point in terms of diversification. We have diversified your portfolio handsomely. You have a well-diversified portfolio. So you don't need to further diversify the portfolio because you end up diversifying it often if you do so. So big picture understanding of your situation is key to your long-term results. And that's, again, I think a big strength that we can bring to the equation. So yes, we cover life insurance, we cover seg funds, we cover hedge funds, we can get our hands on any product on the street, we can get it for you. And we're also getting some calls on crypto right now. I indicated that as well. It's not an easy space. It's not a slam dunk. It's working. It's working on steroids right now. And when anything works on steroids, it goes equally cold. And there is a freeze. I don't know. It will happen. Mark my words. There will be a crypto freeze again. I don't know when, I don't know what levels, but there are ways of playing it. We are continue to look at a number of different ideas. Fidelity has some ideas. There's directly in trading platforms that we can do. Coinbase Global is a stock we have traded. We made some money on Coinbase Global, which is a crypto trading platform. But honestly, you want to compound 8, 9, 10%. Don't need to get sexy. Don't need to get overly cute. Don't need crypto to do it. We came this far without crypto. So, and again, I'm not down on it. I'm not down the asset. What I don't like about it, it doesn't make any money. It costs money. So, yeah, I like business that make money. Microsoft makes money. Apple makes money. Google makes money. Crypto doesn't. But it's an asset class. I have to respect it. We do respect it. But it is spec. It is beta. And if you want to buy stuff like that, if we want to buy, you layer in a little bit of it. You don't need to put half your money into these unique ideas. It's not wise. Core is where the bulk of your money should be. Around the periphery, we can always trim in some additional ideas for you. So, bespoke portfolio is what we create for clients. We want to tell them around you and your situation, but we offer a discussion around that to make sure it's appropriate for you. And I will end with an old advertising line that I use, and it's so true in this business. If it's coming to these discussions about buying these alternative asset classes, don't do so with a 3-minute phone call with us. Come in and see us. Prescription without diagnosis is malpractice. We do not want to perform malpractice with your money in here. Managing your money is so important to us, and we know it's important to you as well. Please, Jack, any final thoughts?
If you guys have any financial questions, we're here for you. We have a lot of resources, as Wolfgang mentioned. Give us a call. We can add value.
Have a great weekend, and please, anything we can do, let us know. We will send out a post view of the conference, and have a lovely week. Looks like great weather. We'll speak to you soon.